Hi, I'm Ed Fulbright, CPA, CGMA, PFS of Fulbright Financial Consulting, PA. We would like to welcome you to our educational briefing.
In this week's news, affecting your wealth, the U.S. economy grew 3% in the third quarter, much faster than what had been expected. The consensus forecast of 59 economists surveyed by the Wall Street Journal in early October had been 2.7% growth. The 3% growth is an estimate, and the final number could be revised in the weeks ahead. For growth to hit 3% in the third quarter, despite two severe hurricanes, the threat of nuclear war with North Korea, and political strife in Washington, D.C., is an impressive display of the current economic momentum. Meanwhile, the House of Representatives took a major step forward on enacting a massive $1.5 trillion tax cut, which will stimulate the already strong economy. The House of Representatives narrowly approved a $746 billion federal budget for the 2018 year, increasing the deficit by $80 billion. Approval of the budget resolution clears the path to massive tax cuts, but the details of the tax cut remain the proposals call for paying for the tax cuts largely by eliminating the deduction on state and local taxes, including property taxes. The budget was narrowly passed by 4 votes in the House on Thursday, with 20 Republicans from high-tax states voting against the resolution alongside Democrats. More Republican lawmakers in states with high income and property taxes may defect and vote against the tax cuts unless the final legislation softens the financial blow to their constituents. High-income urban and suburban communities will be the hardest hit under the proposal, and it would increase deficit spending and weaken the balance sheet of the U.S. government. Should the tax proposal be adopted, your current tax liability for 2017 could decline. This would require last-minute tax planning before the end of the year. Lower taxes will put more money in consumers' hands and boost spending in the economy. The S&P 500, which has been breaking records for months, ended last week at a new all-time high. A correction of 10% or more due to the change in sentiment or some unexpected bad event is always possible, and the 8.5-year bull market grows older. The likelihood of a bear market of a drop of 20% or more increases. However, the inflation is tame, job growth has been strong, and a real growth in wages and disposable personal income are at record levels. Despite the tripling of the value of the S&P 500 since bottoming in March of 2009, the stream of good economic news, irrational exuberance is not an issue. The average price of a stock in the S&P 500 trades at 19.9 times. Its trailing 12-month earnings and 17.4 times the consensus bottom-up forecast for 2018 earnings, according to the Wall Street analyst consensus estimates. Investors have not bid up stock prices beyond their historical valuation range. Despite some troubling headlines, the economy keeps surprising us on the upside, and the bull market could head much higher and run much longer.
Thank you for listening. Please contact us with any questions, and also contact us if you're interested in our complimentary second opinion on your investments or to set up a meeting regarding your wealth. Don't hesitate to share this video with people who might benefit from our work. Thank you again, and have a great day.